Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Honda surges after announcing a $7 billion buyback following a tentative deal to take over its weaker rival, Nissan. French President Emmanuel Macron names Eric Lombard the finance minister. Meanwhile, Prime Minister François Bayrou wants a budget deal with Parliament by mid-February that would cut the deficit to close to 5%. Plus, Syria's new de facto leader, Ahmed al-Sharaa, holds talks with senior diplomats from Jordan and Qatar. It has just gone 8 a.m. across the Emirates. I'm Joanna Versace in Dubai. Well, this is my last show of the year. Not the last show for Horizons, just my personal last show of the year. So I've got to make it a good one for you. Happy Christmas Eve Day for those who are celebrating. And thank you for joining us and watching the show if you are. The Santa rally continues, though. Wall Street saw a better end to the session yesterday. Both the S&P and NASDAQ up in the green. The NASDAQ up more than 1%. S&P tracking gains of about 25% for the year. NASDAQ more than 30% higher for the year. Interesting tidbit I thought I would flag. About half of the rally in the S&P can be pointed down to the Magnificent Seven. So yes, that concentration still very much alive. Today, S&P futures not doing that much. NASDAQ futures the same, sort of leaning around the flat line. And to be honest, we're heading into a holiday period now. Very thin trading, and most of these markets are going to be ending early. But that's a picture for today. 10-year yields also about 6 basis points higher yesterday in trading, back up to 4.58 despite a better than expected 2-year auction. That being said, we still saw upward pressure on yields. And then dollar yen in focus today. We're trading around the 157 handle. This as we're getting some jawboning commentary from the Japanese finance minister saying that they will not tolerate excessive moves. So raising some questions about whether intervention could be nigh. Remember, back in July, we got to around 160, 161 with dollar yen. Speaking of the dollar, let's switch over, because I want to show you something about the performance of the USD in the last quarter. And this terminal chart shows you that the US dollar has been is on track for its best quarter since late 2016. So this really encapsulates a lot of the momentum that we've seen going into the greenback in the last couple of months, and also one manifestation of that Trump trade into and out of the elections, and this view that US exceptionalism is going to stay with us into 2025. So that's the USD. Let's also check in on how markets in Asia are faring today. Evil Hong is in our Singapore studio. So much on deck. A lot of focus, of course, on the Nissan Honda deal. But tell us more about how markets are reacting.
Yeah, I think Japanese auto stocks are really in focus today. We saw the likes of Honda surging as there was a sweetener in terms of the share buyback. But the rest of the region also pretty positive, despite those declines you're seeing on the Nikkei. And this is, I think, a tracking of Wall Street's gains that was led by tech stocks. Amid this optimism of Fed rate cuts, there's a bit of a Santa Claus rally underway as well. That being said, for the region's benchmark, it's still heading for losses for the quarter. Now, the outperformer today is the likes of these Taiwan tech-related stocks. Although the TAIEX is pairing some of the earlier gains, we're seeing most of these chip-related stocks in Taiwan actually extending their gains. This is following on from the chip stock performance, but also there's been talk about how the best way to play the AI theme is going to be for the NVIDIA supplier TSMC. So these are among the stocks that have been gaining ground today. But of course, as I mentioned a short while ago, it's also about these Japanese automakers. Jumana.
Yeah, and TSMC, actually, I've just seen, is at a record high. So, yes, keeps going from strength to strength with the chip makers, specifically TSMC in your region. Avril, thank you so much. Now, speaking of those automakers, big swings in shares of Honda and Nissan in Japan's morning session after Honda sketched plans for a deal that amounts to an acquisition of Nissan. Take a listen.
Once the definitive agreement is concluded, the holding company will be incorporated and be listed on the prime market of the Tokyo Stock Exchange, subject to obtaining necessary approvals from relevant authorities in resolution at each company's general meeting of the shareholders. The visibility of the timing is August 2026.
In order to work together, we need to benefit from the huge synergies. Otherwise, it wouldn't be meaningful in the eyes of the stakeholders. So that is why we agreed to start the discussion. That is why we are making this announcement today.
Well, big news in the auto space. For more, let's bring in Bloomberg's breaking news editor, Gareth Allen. Gareth, it seems to me that this is more of an acquisition as opposed to a merger. What do we know about the contours of the deal?
Yeah, that's exactly right. I mean, Honda is by far, in terms of market cap, is about 4 times bigger than Nissan, so it's clearly the senior party in this. And of course, Nissan has been in so much trouble after they ousted Gordon all those years ago, and they've been going from worse to worse. They're struggling in the US, they're struggling in China as the electric makers come to the fore, and together they believe that they're going to be able to better combat that competition from China. And it seems that Honda is certainly the dominant partner, going to be the dominant partner. They're going to be making most of the board's appointments. So it'll be interesting to see how that plays out and which personalities remain there, whether Mibe becomes the top and what will happen to Ichida from Nissan. And the other factor, of course, is how Mitsubishi will come into this partnership as well.
Yeah, I was going to say, I mean, if you look at the structure of Renault, Nissan, Mitsubishi, it's quite complex who owns who and the partnerships and various, I'm sure we've all seen the graphics. So from this point onwards, how can we expect the deal to play out vis-a-vis some of the other players involved in the alliance as well, Mitsubishi and Renault?
Well, that's very right. And of course, Foxconn has also been circling in the background there, and there was actually talks that they were approaching Renault to buy out Renault's stake of the company. But that seems at the moment we've heard from sources that they're putting that on the back burner for now, and they're going to be out of the picture. So that does, in some terms, simplify it. I guess the next step is, will Mitsubishi be at the table or won't they be at the table, and how this is all going to play out. They've said they're going to look to form a holding structure company, and they want to list that new company. They're talking around August 2026 for that. So there's quite a long time between now and then that this will play out, and we'll have to wait and see what the next announcements are and how that's going to look going forward.
Yeah, certainly big news in the space. Bloomberg's breaking news editor, Gareth Allen, thank you for bringing us the latest. Well, French President Emmanuel Macron has picked Eric Lombard to be the country's finance minister. Lombard, an experienced finance professional, faces the task of repairing France's finances after the collapse of the previous administration over next year's budget. The country has been in political turmoil since June, when Macron dissolved parliament and called for elections. France's new Prime Minister, François Bayrou, wants a deal on the 2025 budget, which brings the nation's deficit down to close to 5% of GDP without unreasonably targeting companies. And over in this part of the world, Syria's new de facto leader, Ahmed al-Sharaa, has held talks with senior Arab diplomats in the latest high-profile visit since the overthrow of Bashar al-Assad. AFP is reporting Qatar's Minister of State at the Ministry of Foreign Affairs, Mohammed al-Khulaifi, led the first high-level Qatari delegation to Damascus after 13 years of diplomatic rupture during the former regime. Jordan's foreign ministry also has released images showing Foreign Minister Ayman Safadi meeting with al-Sharaa in the Syrian capital. State TV says both leaders discussed avenues of cooperation, including in the areas of trade, border management, aid and electricity connections, along with security. For more on this, Honor and Bloomberg's managing editor for the Middle East and North Africa joins me now. So Ahmed al-Sharaa has been quite busy the last couple of days, meeting with diplomats from around the world. Yesterday, we were speaking about Saudi Arabia. Now, Qatar and Jordan, ministry officials are meeting with him. What should we make of all of these discussions that are taking place? And is it a validation of sorts for Ahmed al-Sharaa and his transitional government?
To answer the second question, your first, yes, Jumana, that definitely a validation of the interim government led by Ahmed al-Sharaa. But also what we're seeing is that regional powers, both Turkey and now the Arab states of the region, including the UAE officials who called the Syrian interim government, according to a statement this morning by WAM, we're seeing that the regional leaders are trying to introduce a sense of normalcy to their relationship with Syria's rulers after 13, 14 years of estrangement, as was mentioned by the Qatari foreign minister yesterday. Secondly, we're seeing that not only they are pushing for their interests to be sort of prioritized by the new Syrian government, which is the stability of Syria and its unity, but also we're seeing that they are offering ways to help the new Syrian government sort of country back on track of recovery. Much of the country was devastated by 14 years of war. From services to construction, they're going to need a lot going forward in terms of financing and know-how. And we're seeing the Arab leaders and regional leaders are offering just that. And I think good example in this case is Qatar is offering help with management of the Damascus International Airport.
Yeah, and most of the attention has been on Syria, the developments in Syria the last couple of weeks, but let's also not forget the conflicts that are raging around the region as well. I thought it was interesting yesterday that the Israeli Prime Minister Netanyahu, in a speech to the Knesset, mentioned that there has been some progress on a ceasefire potentially in Gaza and the release of hostages. Is there hope for a deal by the end of this year?
Yes, there is, but I think we should be careful about the evolution of that, the main conflict, as you said, Jumana, in the background. On the one hand, Israel seems to be on track to secure some kind of hostage or ceasefire deal with Hamas. They've been talking about the state of talks as has been never better than they have been recently. Both the Israeli officials and some of the interlocutors that are mediating those talks. But we have seen this before many times since basically last April. So it's very difficult to say that a hostage deal, a ceasefire deal, is just around the corner and imminent. It is possible to clinch that by the year end, in a week or so, but I wouldn't hold my breath. We have seen too many times that these talks sort of flounder, collapse in the last minute. And at the same time, we're also seeing an evolution in the conflict surrounding Israel, where Israel's military focus, seems to be shifting away from Gaza and Lebanon to Houthis, which may also be creating some sort of space for this Gaza hostage truce deal to take place, if that will eventually actually materialize.
Yeah. Interesting also that you bring up Houthis as well with the attempted missile attack in recent days on Tel Aviv. Honor Ant, Bloomberg's managing editor for the Middle East and North Africa. Thank you very much for the reporting. Well, still ahead, hear why Moody's Analytics has changed their Fed expectations and is now looking at 50 basis points worth of cuts in 2025. More on their economic outlook next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersachi in Dubai. Well, new voters will join the Federal Reserve's interest rate setting committee in 2025, bringing fresh perspectives to the decision-making process. This, of course, on the heels of what was interpreted to be a more hawkish than expected FOMC rate cut decision last week. The market reaction was pretty telling. Let's bring in Katrina Ell, Director of Economic Research at Moody's Analytics, to discuss the ramifications of that FOMC meeting last week. A bit of a winter surprise, I would say, for market participants, certainly judging by the price action, the massive repricing of yields that has taken place. Let me just start off by asking you whether you yourselves have revised your outlook for how many rate cuts we could see out of the Fed next year.
Yes, definitely. We most certainly have. I think right now we're looking at only 50 basis points worth of reductions over the course of next year. So that's quite a step back from the 100 basis points worth of cuts that we and consensus were expecting. I think what's been clear is that inflation is, not, decelerating and not going to quite play ball to the extent that was previously expected. I mean, if we're looking at projections for inflation for next year, that the PCE deflator is now looking like it'll end 2025 around the 2.5 mark. So that's quite a bit higher from the 2.1% previously expected, and also above the Fed's target of 2%. So it just doesn't make a whole lot of sense to be pushing through more aggressive cuts when you do have that more elevated inflation profile. And I think the other point to note that's interesting is that now the neutral rate is also looking like it's higher as well. So we're looking at it being around the 3% mark. And last year, we were looking at it being around 2.5%. So what's the key takeaway from that is that we don't need to cut rates as much to bring the policy settings back to a neutral rate. So that's good news as well. So basically, less cuts are needed to get back to neutral at this point.
Yeah, but it's interesting that they would cut rates at the same breath as revise upwards their inflation forecast for 2025. I think that was a bit surprising to market participants. But let me just park that for a second and ask you more broadly about the state of the U.S. economy. Yesterday, we had consumer confidence numbers surprise to the downside. How closely should we be watching figures like that for metrics on how fundamentally the U.S. consumer feels going into next year?
Yeah, I think that's a really good point. I think we really need to pay incredibly close attention to sentiment on the consumer side and also on the business side as well, because consumer sentiment, business sentiment, it's really critical that households maintain faith in the economic resilience that the US economy has been experiencing. If they start to lose faith, then that's when we will start getting into trouble, I think. And so what's really important, going forward is looking at why, with that US consumer confidence data that we got out yesterday from the conference board, it told us that consumers are really worried about the inflation picture heading into next year. They're worried about what the possibility of tariffs and politics will mean for inflation, because let's remember, inflation has been a thorn in the side of households for quite a few years now, and they were really hoping that kind of period was behind them. But now it looks like there is that threat, looming large, which is affecting their sentiment heading into next year.
Yeah, fair point. And even before Trump has taken office, people are already getting very concerned about what all of these tariffs, if they do get implemented, could mean for the trajectory for the global economy. How do you expect it to play out in terms of the winners and losers next year?
Yeah, I think you raise an incredibly good point with the if. At this point, we just don't know basically the policy priorities of Trump and the aggressiveness with which he's going to pursue those policies. We know from the first Trump presidency that there can be quite a large gap between what's announced and then what's actually implemented. And I think that's going to really, dominate a lot of the economic and political landscape next year. If we do see really aggressive tariffs from Trump, then we know, trading partners like Mexico, China, and others in Southeast Asia will be key, hit. And then we will see retaliation as well. And so that's obviously going to influence not only economics, but also the geopolitical side of things as well. And I think we not only need to pay close attention to what Trump says, but also we need to pay close attention to how the US-China relationship evolves, because we know as well from that first Trump presidency that when the two largest economic players are at loggerheads, it has sustained negative consequences for the global economy, not just from an export point of view, but also from that sentiment channel as well.
Very valid. Well, we've got a China guest coming up in the second hour of the show, so I'll put some of those questions to him. Katrina, thank you so much for joining us on Christmas Eve Day. Katrina Ell, Director of Economic Research at Moody's Analytics. Well, coming up, it's up to President Biden now to decide on Nippon Steel's bid for U.S. Steel. We get the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersechi in Dubai. President Biden is set to make the final decision on the sale of U.S. Steel to Nippon Steel. That's after a national security panel deadlocked on its review of the sale. The president has long indicated his opposition to the transaction. So for more on this, Bloomberg's Stephen Sachinski joins us now. Stephen, everything that Biden has said the last couple of months suggests that he is opposed to this deal actually going through. What can we expect out of him, and by when should he be making this decision?
Right. So the CFIUS review came in. There was no suggestion. The committee was split. So now, yes, it's up to Biden to make the decision. He has signaled in the past that U.S. Steel should be American-owned. He hasn't come out as strongly publicly as Trump in terms of saying that they'll kill the deal. Trump has said that day one or early in his administration, he would not approve it because he believes that U.S. Steel should be an American company, not owned by any company overseas. But you have to remember that Biden he's indicated that he's not in favor of it. Part of that, there could be a few reasons for that. One, this is a very hot topic. U.S. Steel has a storied history in the rise of America since World War II and the booming economy since thereafter. On top of that, Biden is from Pennsylvania, home to U.S. Steel and the steel industry in general. Plus, the unions have been opposed to it. So all those together has indicated that within 15 days, Biden is likely to shoot it down. And Bloomberg has reported previously that that's where the White House is heading at the moment.
Why does the deal make strategic sense to begin with? We talked about perhaps the political side of things, but why are Nippon interested in U.S. Steel?
Well, Nippon Steel is Japan's largest steel maker. Again, very similar to the U.S. Steel story. They rose to prominence after World War II with the rebuilding of Japan and riding the big economic boom thereafter. But in the years since, they've struggled to compete with China, which has overtaken the U.S. and Japan as the world's largest and most powerful producer of steel. They produce more than anyone else. They've flooded the market with the product. So it's become challenging to compete against the Chinese. So for Nippon Steel, they want to leave the Japanese market and expand outside. They've targeted the U.S. as a growth market in the energy transition. There's an expectation that the U.S. will require more steel, but U.S. Steel have been struggling to upgrade their facilities, to revitalize their own companies. So this sort of alliance with a big price tag, might I add, Nippon Steel was paying quite a high premium for U.S. Steel. That would help to create this alliance between the countries and the companies to help compete, consolidate against a Chinese rivals.
Yeah. And of course, the committee's major concern is vis-a-vis national security risks. So it's going to be interesting to see how this all plays out, especially as we head into the final weeks of President Biden's term. Stephen Chasinski in Singapore, thank you so much for the latest there. A look at U.S. equity futures as we head into what's going to be a shortened holiday trading day. Everything is leaning towards the red. Euro Stoxx futures also down about 0.5% as we get into the European session. Coming up, stocks in Asia saw muted gains amid relatively thin holiday trading. Krane Funds Advisors shares their market strategy next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Honda surges after announcing a $7 billion buyback following a tentative deal to take over its weaker rival Nissan. French President Emmanuel Macron names Eric Lombard the finance minister. Meanwhile, Prime Minister François Bayrou wants a budget deal with Parliament by mid-February that would cut the deficit to close to 5%. Plus, Syria's new de facto leader, Ahmed al-Sharaa, holds talks with senior diplomats from Jordan and Qatar. It's just gone 8:30 a.m. across the Emirates. I'm Jemana Versace in Dubai. The Santa rally continued yesterday. Wall Street ending up in the green. Both the S&P and Nasdaq ending almost 1% higher, on track for gains of 25% for the year for S&P, more than 30% for the Nasdaq. This morning, S&P futures trading sideways. We're heading into quite a thin day of liquidity. It's a shortened holiday day for trading as well, and very little in the way of data, though we do have the Richmond Fed manufacturing number to watch out for those who are watching U.S. data. The handover from Asia Pacific overnight, pretty positive. You see the MSCI Asia Pacific in the green, up 0.4%. Actually, a bit of a rebound in the Hang Seng this morning as well, coming through. Brent not doing a whole lot, sitting around the $73 mark. We are trading slightly firmer today, though. Of course, we've been in that very tight range over the course of the last couple of months, sort of in a 71 to 75 range, despite everything that has happened geopolitically and with that OPEC Plus decision. And then dollar yen in focus as well. We spoke about this earlier. We're sitting around 157. We did have some comments from the finance minister overnight saying that excessive moves will not be tolerated. So again, a bit of jawboning coming through there. Remember, back in July, dollar yen got as high as 160, 161. As for our terminal charts, and this I just want to highlight to you, is the moves that we've seen in yields. We've got 10-year yields sitting close to 3.6% now. But take a look at this. Typically, the 10-year yield will move down after the first Fed cut. So if you go all the way back to the 80s, this is the typical move that you would get. This time around, things have been different. And if anything, we've sold off a huge amount. It's 80 basis points higher than that first interest rate cut out of the Fed. So very interesting dynamic going on here. And I guess it opens up the opportunity to ask why that is the case as we head into 2025. So we'll park that one there. Now, President Biden's administration is launching an investigation into Chinese-made semiconductor chips. It's a move that could lead to new tariffs. Our China correspondent Min Lo joins us from Hong Kong. So interesting also that it's happening the last couple of weeks of the Biden administration. What's new about this particular investigation, Min?
Yeah, the Biden administration clearly trying to get its agenda through before he steps down, and the Biden administration is now investigating these legacy chips sold by China. These are older generation technology. They're very ubiquitous. They're used in everything from cars to mobile phones to airplanes, medical devices, and it would pave the way potentially for higher tariffs or perhaps import restrictions. But obviously these sort of investigations, they usually take many months, 6 to 12 months even. So when by the time it's concluded, Biden would have stepped down, and that leaves the decision of what to do with the outcome of this investigation. It will be left in the hands of President-elect Trump and his incoming administration. And of course, the U.S. officials right now are saying that the existing measures so far is not enough to prevent a potential dumping of cheap Chinese chips in the U.S. market. Currently, we know Washington has already announced that they are increasing the tariffs on these legacy chips from the existing 25% to 50% by 2025. But some U.S. officials are also saying that these chips, if they're overly controlled by China, that it could pose a national security threat to the U.S. as well.
Yeah, I've got to be honest, I'm pretty surprised that some of these China chips are being used in the U.S. to begin with. But given how long it's going to take for the investigation to yield results, have China already responded, or are they going to be patient and see what the findings show?
Well, the Chinese Commerce Ministry has responded. Obviously, they are opposed to this investigation. They're also pointing out the double standards here, saying that the U.S. is also pouring huge amounts of subsidies into U.S. companies through the Science and Chips Act, and that U.S. companies now make up about half of global market share, while Chinese chips make up only just 1.3% of U.S. market share. So the Chinese ministry statement says that this is, quote, obviously self-contradictory, and that the U.S. is exaggerating the Chinese threat, and China says it will take every necessary action to protect its legitimate rights and interests.
Interesting. Bloomberg's China correspondent Min Lo, thank you so much for the reporting. Well, a recent bounce in Chinese developer stocks might be short-lived, with the country's real estate woes set to worsen before they get better. For more, let's bring in Anthony Sassine, head of MENA Senior Strategist at Krane Funds Advisors. Great to have you with us on the show, Anthony. Thanks for joining us. That piece that I was just referring to was one that we've written up in the terminal this morning. It's a really good read because it sort of gives a preview for the China property market going into 2025. And the takeaway is most analysts seem to be pretty negative. Morgan Stanley, for example, they're saying that they expect sales to drop 12% in China next year, home prices to decrease by high single digits from November's level. How do you see the outlook specifically for property next year?
Yeah, property has been a big issue in China, especially for the past 2 years, driven by regulations inflicted by China itself. And we're seeing that ripple effect now through the sector, which has been affecting consumer. And it's not an easy issue to resolve, right? There's a lot of supply in the market. You have depressed consumer sentiment, and it takes a little bit of time to get consumers to go back and buy homes. But China is adamant on fixing this. They've been rolling out a lot of measures for real estate, for other things, lowering rates. We've seen after these measures, second homes increase in a big way in November and October. So China's going to keep working on this, but that's going to take a little bit of time. And it's very imperative that local governments start participating in this and buying off the oversupply in the market.
Yeah, that was one of the solutions that the government sort of proposed earlier this year. Let me ask you, is China capable of achieving those 5% growth numbers in the absence of a rebound in the property market? Can the two things happen simultaneously?
I mean, China has achieved this goal for the past 20-plus years, right? So it's next year most likely.
But it was a different model of growth.
Absolutely, but they keep reinventing the wheel, right? They keep finding ways. This year it was very difficult. Actually, analysts thought it was going to be very difficult for China to achieve it, and then they came up with a bazooka stimulus in addition to some consumption programs like trade-in value, upgrading equipment that really moved the needle and pushed growth to 5%. Next year is going to be a little bit harder too, especially with Trump, because this is going to have a big impact on growth, on export growth, which is a decent size of the GDP. So that's why we think China is going to have to push all the way on consumption and investments to make it up. And one of the ways of doing this is real estate. So real estate is going to be a harder issue, but getting people to spend with now record savings, it could be done.
Yeah. One thing that has showed up in the recent data, just the last couple of months, is manufacturing and exports have actually done well. And people are saying that it could be potentially front-loading ahead of this potential tariffs or imposition of extra tariffs on Chinese goods once Trump takes office. Do you espouse that view as well?
Yeah, so there are a couple of factors here. One of them is a little bit of front-loading, not just from Trump, but also from Europe, especially in the EVs and electric vehicles, because some of the tariffs went into October, but also some of the programs that they put in, like the trade-in value, trade-in programs, and then where you get subsidies up to 20,000 for EVs, 10,000 yuan for ICE cars, also for the appliances and the trade-in equipments as well that they've done. This generated close to 2 trillion yuan in sales, right? 600 billion, 700 billion for cars alone. So these programs really help push manufacturing up and sales up in October and November. So it was kind of a combination that China could still do more, even more broader next year on more products and services.
Is China now stuck in a deflationary trap? You look at the most recent prints, PPI negative, CPI has been very close to zero, very far away from their sort of 3% target. What can they do to get out of this? And if they are in this sort of deflationary environment, what ramifications does that have on business? Yeah, this has been the issue all along, right? We've been talking about for 2 years. It's not supply side, it's demand side, right? You have a big issue with demand, and that's driven by low consumption. The consumer sentiment is depressed, so you need to figure out ways to stimulate the consumer, do direct stimulus to consumers like they did in the US and Europe, sending checks, increasing wages, transferring economic gains from manufacturing and industry to consumption. And this is what China has not done so well yet, right? So by bringing back consumer, you'll be able to lift inflation and lift demand, right? So that's where the key is. You say they haven't done it yet. What are they waiting for? Good question. So for the past 2 years, I mean, we've been talking about direct consumption, and they haven't done it. They focused all the time on supply side, lowering rates, manufacturing, where the marginal utility of these actions were just kind of declining, right? 2 years ago made a big difference. Today, it's like, whoop-de-doo, another rate cut, which is not needed in a big way. So they have to figure out a way to transfer these economic gains to consumption. There's record savings with the consumer. There's no reason why the consumer should not be able to pick up the slack from here, especially after no spending for 2 years. And that's what we expect the government to do in 2025. We think it's going to be the year of the consumer, right? And that the government is slowly coming to reality where they should be doing. I guess it brings you back to where we started, which is the property market, because so much of the Chinese consumer wealth is tied up in the property market. And so in order for them to feel more confident about going out and spending, they need to see the value of their assets actually rise or at least stop depreciating. 100%. It's a big part of it. We just want to see it stabilizing, right? But also jobs,
for the youth, also wages increasing.
Yeah.
So all these will make a difference.
Okay, final question for you. We've seen a big rebound in markets, and specific Chinese markets. Shanghai has soared since the end of the summer. Have we sort of reached a point now where all of the news is baked in? The good news, in terms of the fiscal stimulus that's been announced, and then the bad news in terms of what could happen under a Trump administration. Are we sort of at this neutral point?
Yeah, I think the market is pricing in a more dire scenario, right? So China is just starting on the stimulus. We saw what could happen back in September if you ignore China. If you have zero allocation in China, you're at a big risk, right? Especially from tracking error perspective. You caught the downside, and now you're missing the upside. So that's why I think China is going to keep doing what they need to do, and valuation is still very low. Positioning is still very low, especially vis-a-vis the U.S. and emerging markets like China, multi-decade lows. So these are going to have to come back, and the gap is going to close at some point. Once you start seeing the macro improve, and we're looking at real estate, we're looking at consumer sentiments, these are the main gauges that would actually indicate that China is moving into second gear.
Interesting. Okay, Anthony, thank you so much for sharing your views with us as we get into 2025. Anthony Sassine, head of MENA and senior strategist at Krane Funds Advisors. Well, coming up, Mali, Niger, and Burkina Faso will not be swayed from their decision to exit ECOWAS. More on the impact next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Versace in Dubai. Military leaders from the West African Junta-led nations of Mali, Niger, and Burkina Faso have dismissed a proposal from regional trade bloc ECOWAS to postpone their exit by 6 months. Mali's military leader said the move is another destabilization attempt targeting the Sahel states in a last-ditch effort to avoid its fracture. For more, let's bring in Bloomberg's Ondiro Aganga. Ondiro, why are those Sahel countries so keen to leave ECOWAS?
Jumana, there are a couple of factors at play here. One is French influence. You have these three Sahel states saying that ECOWAS is under French influence, and that's why we are seeing that spirited opposition against them. And also there's growing anti-French sentiment in the region because France continues to have a lot of power over the region. The other factor is that they feel like ECOWAS has not been supporting them security-wise as they continue to fight Islamist insurgencies and jihadists in the region that has brought insecurity and also destabilization. On the other hand, ECOWAS has zero tolerance policy of a military coup, but in the last 5 years, we've seen about 7 military coups, the last one being in Niger in July of 2023, where the Presidential Guard ousted President Mohamed Bazoum. We saw ECOWAS in turn imposing financial and economic sanctions and even threatened military intervention if the president was not reinstated. So this is some of the factors that have been causing tension. You also have ECOWAS saying that they prefer civilian rule government, but these three states have not shown any sign of moving towards election. Mali has postponed elections twice. Niger says they need 5 years of transition, and Burkina Faso has placed it at 3. These people intend to continue holding on to power until they're forced out. So this is some of the issues that they've been pushing and pulling amongst themselves.
And ECOWAS obviously were keen on them staying in the bloc. What are the implications of these countries actually leaving?
Jumana, there's a lot of weight with these countries leaving. First of all, it comes with trade. If you look at these three countries, they're landlocked. So they depend on some of these ECOWAS countries for importing food, medicine, fuel, and electricity. But on the other hand, they also expect that they export their resources, such as gold and uranium, through the ports of West African countries. So if that stops, then these West African countries that have coastlines are likely to lose a major source of their revenue. The other impact is going to be on things like power vacuum. Cutting ties with ECOWAS and also France leaves a power vacuum. US, EU not likely to touch this region until civilian governments are reinstated, and that leaves Iran, Turkey, and China as the main contenders. Then you have Russia that have already set base, and they're really comfortable in the country. They're partnering, they're selling them weapons, and we've also had their mercenaries from Wagner Group, which is now Africa Corps, fight alongside these military organizations. So that is what is currently happening. They've tried forming the alliance of the Sahel states, but it's still an organization on paper because pacts on security, finances, and infrastructure development are yet to be put in place.
Interesting. So big geostrategic implications potentially, talking about the rest of the world, not just specific to the African continent. And I just want to pick up on a story that we were speaking about yesterday, and that is what has been going on in Mozambique. The ruling party's Chapo has now been declared president-elect by that constitutional court. We spoke about it yesterday. What does this mean for the country going forward, and can we expect more protests and more demonstrations as a result?
Jumana, this ushers in a new transition phase of leadership from Filipe Nyusi to President Daniel Chapo, and it continues the reign of the ruling power. They're also likely to continue having majority in parliament and dominance of a lawmaking process. And while this verdict solves one problem, it creates another. These elections were really highly contested. People were dissatisfied with these results. Protests turned deadly. We've seen 130 people have lost their lives. And social issues have also come up. 500,000 graduates annually, yet 1 out of 3 are struggling with unemployment. And this is some of the issues that Mondlane, who's the opposition candidate, has used to continue fueling the fire of discontentment amongst the people. So this verdict puts Daniel Chapo, the new leader, at the center of this division. And he spoke to Bloomberg yesterday saying, I know that this is a complicated situation, but we will find a solution.
All right. Well, as you're reporting, we are just taking a look at some of the protests that have been taking place the last few months. And as we were talking about yesterday, it's also meant that the economy has come to somewhat of a standstill as of late. Bloomberg's Ondira Ganga, thank you so much for those updates. Now, Nigeria's president has defended his sweeping economic reforms, which triggered soaring inflation, led to a cost of living crisis, and sparked deadly protests. Bola Tinubu told a rare media briefing in Lagos yesterday that the measures, including devaluing the naira, abolishing a complex exchange rate system, and scrapping costly gasoline subsidies, were necessary to prevent a national crisis. Coming up, we hear from Minneapolis Fed President Neel Kashkari on why he thinks what happens in China matters to the world. Next, this is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Amid the heightened trade tensions between Washington and Beijing, Minneapolis Fed President Neel Kashkari says what happens to China's economy matters to the world.
You know, there's obviously the risks of potential tariffs back and forth between the U.S. and China, which are notable. The other big concern is just the domestic Chinese economy and the slumber that it appears to be in. From our analysis, the heavy weight of the housing sector that has been a driver of Chinese growth for so many years is now appears to be weighing down the Chinese economy and just the struggles that the Chinese economy is facing. And so I'm just something that I'm watching a lot is what the policymakers in China do, and can they get the Chinese economy on a stronger, sustainable growth path? You know, reinflating, so to speak, their housing bubble doesn't seem like it's a long-term strategy. So what is China's growth strategy? I agree the potential tariffs between the U.S. and China and back and forth is something to pay close attention to, but I think China's own domestic challenges are also notable.
Do you think that if China's economy remains lackluster, we could see some contagion and other Asian economies and perhaps even further afield may get impacted as well?
Certainly possible. I mean, China is obviously a huge economy, and if a huge part of the global economy just grows slowly, that's obviously going to have an imprint on everybody else. For example, commodity markets would be one of the first places that we would see that, whether it's for steel or for iron ore or other metals or other minerals. So that's something that we're going to pay close attention to because it just matters a lot for the global economy. But then I also think many other Asian economies are linked to economies all around the world. I was just looking at some analysis on where the U.S. imports most of its goods. Of course, China dominated that 6-10 years ago, and China's share exporting directly to the U.S. has actually fallen quite a bit. And countries like Mexico and other Southeastern Asian countries have picked up the slack. And so I'm actually optimistic that other Asian economies could continue to perform well because they're connected to the U.S., they're connected to Europe, to South America. But of course, China is just so large that what happens in China matters to everybody.
Minneapolis Fed President Neel Kashkari speaking with Insight anchor Haslinda Ahmed. Now for a look at some of the other stories we're following. Former U.S. President Bill Clinton has been hospitalized for observations after developing a fever. A spokesman says the 78-year-old remains in good spirits. The former president was active on this year's presidential campaign trail. Clinton underwent quadruple bypass surgery back in 2004. A U.S. bipartisan committee report has found what it calls substantial evidence that former Representative Matt Gaetz paid several women, including a 17-year-old girl, for sex and used illegal drugs while in Congress. The committee report accuses Gaetz of violating House rules and standards of conduct, including prostitution, statutory rape, and obstruction of Congress. Gaetz has denied all wrongdoing and dismissed the allegations. Malaysia's state-owned investment fund, 1MDB, has filed a $1 billion claim against a Hong Kong-based corporate services provider to recover its stolen assets. 1MDB said that Amicorp facilitated fraudulent transactions worth over $7 billion and played a vital role in enabling the government investment company to be defrauded. A look at equity futures before we head out into the second hour of the show. Not doing a whole lot on this holiday trading day, but Euro Stoxx futures are trading down 0.5%. This is the S&P and Nasdaq come off strong gains yesterday. That's it for the first hour of Horizons Middle East and Africa. I'll be back for the second in just a moment. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Honda surges after announcing a $7 billion buyback following a tentative deal to take over its weaker rival Nissan. President Emmanuel Macron names Eric Lombard as the new French finance minister. Prime Minister François Bayrou says he wants a budget deal by mid-February to cut the deficit to close to 5%. Plus, Syria's new de facto leader, Ahmed al-Sharaa, holds talks with senior diplomats from Jordan and Qatar. Well, good morning again. It's just gone 9 a.m. across the Emirates. I'm Joanna Bersachi in Dubai. Welcome to the second hour of Horizons Middle East and Africa. And we are on, Christmas Eve day, trading day. So it's going to be quite thin liquidity as we get closer into the European session. And for many of these markets, it's a shortened trading day today. That being said, the Santa rally continues because we saw both the S&P and Nasdaq end in the green yesterday. S&P very close to 6,000. So many analysts at the beginning of the year had set 6,000 as their target for S&P. Well, we're almost there, and the index is up more than 25% year-to-date. Nasdaq up more than 30%. So it's really been a strong year for U.S. equities. This is the picture today, though. Futures not doing a whole lot in terms of data. The only data point to watch out for in the U.S. is the Fed manufacturing survey, the Richmond Fed manufacturing survey. So that's one other point that we can watch out for later this afternoon. 10-year yields continued their climb higher. We moved about 6 basis points higher yesterday. 4.58 is where we are at. And again, this is in light of that hawkish Fed meeting last week, which saw yields move significantly higher and a massive repricing out of some of the Fed cuts that were priced in for 2025. Now only about 40 basis points priced in for all of next year. Dollar yen sitting at 157, and this again has come back into our focus because of some of the pressure being sustained on this currency pair. Some weakness coming through from the yen. We had a surprisingly dovish Bank of Japan meeting last week as well, but then the dollar side of the equation has been doing really well. So let me just flip over and show you for the last quarter. The dollar has actually done the best for the quarter since late 2016. So its best performance in almost a decade, if you look at that green bar over there. So very strong quarter for the greenback. And some of that was just, as we spoke about, a manifestation of that Trump trade. So into the elections and out of the elections, the USD has done really well. Now, over in auto space, Honda shares are soaring as much as 14% today after the Japanese car makers said it will buy back as much as $7 billion of stock. This less than 24 hours after it was confirmed it was in talks with Honda over a possible, over a possible business integration.
Once the definitive agreement is concluded, the holding company will be incorporated and be listed on the prime market of the Tokyo Stock Exchange, subject to obtaining necessary approvals from relevant authorities in resolution at each company's general meeting of the shareholders. The visibility of the timing is August 2026.
In order to work together, we need to benefit from the huge synergies. Otherwise, it wouldn't be meaningful in the eyes of the stakeholders. So that is why we agreed to start the discussion. That is why we are making this announcement today.
Well, for more, let's bring in Asia Transport reporter Danny Lee. Danny, yesterday we were talking about this potential announcement to come, and now we know it's happening for real, the talks between the two sides. But I guess, you know, from an outsider standpoint, this is more of a rescue mission for Nissan than a merger of sorts.
Yeah, it feels more like a takeover of Nissan, frankly, given the weakened position it's in. And after investors digested the news of this potential merger that will now, talks will take place through until the middle half of next year. You just look at the investor reaction. Opening in Tokyo, Honda jumped almost as much as 70%. It's now come off those highs. Interestingly, Nissan was down as much as 7%. Then in the last few hours, it pulled back off those losses, was trading flat. Now it's actually jumped 5% higher, frankly. So it's you can see who feels like they're going to be the winners here. I think Nissan feel they're in a good position given the weakness they're in. But yeah, of course, Honda offering a sweetened buyback of $7 billion at the same time to try and appease any disgruntled shareholders out there.
Yeah. Well, typically you wouldn't see such a massive move up on a day of a company announcing an acquisition, but I think the share buyback is what got these stocks soaring earlier on in the session. Danny, what are auto analysts saying about the potential for this merged entity to be able to compete with the likes of those Chinese automakers that we were talking about yesterday, and the threat that they have introduced to the EV sector as a whole around the world, not specific to Japan?
I think there is an attractiveness that analysts see in having a scaled-up company with maximum synergies, you know, to try and better effectively compete, not just against the Chinese EV makers and the Chinese auto sector at large, but of course against Toyota. Toyota being the largest in the world out there. So, for Honda, Nissan, and eventually, if Mitsubishi decides it wants to participate, becoming potentially the world's third largest automaker by sales, it gives a real serious heft here to having the kind of competition that can really stand the Japan auto sector in good stead.
Yeah. Well, let's see how all this story plays out. And we haven't even spoken about Mitsubishi and Renault and how they see this all panning out as well. So still plenty of other ramifications. Danny Lee, Asia Transport reporter, thank you with the latest. Well, over in France, the President Emmanuel Macron has picked Eric Lombard to be the country's finance minister. Lombard, an experienced finance professional, faces the task of repairing France's finances after the collapse of the previous administration over next year's budget. The country has been in political turmoil since June, when Macron dissolved parliament and called for elections. France's new Prime Minister, François Bayrou, wants a deal on the 2025 budget, which brings the nation's deficit down to close to 5% of GDP without unreasonably targeting companies. And over in this part of the world, Israeli Prime Minister Benjamin Netanyahu says some progress has been made towards gaining the release of the hostages held by Hamas in Gaza, but says it remains unclear how long it will take to free them. Meanwhile, Israel also says it was behind the assassination of Ismail Haniyeh, the Hamas political leader who was killed in Tehran back in July. It's taking them quite a long time to confirm that it was them behind it. Let's go to Jerusalem now and speak to Bloomberg's Dan Williams. Dan, maybe let's just start with this talk. I think yesterday during the Knesset speech, Israeli Prime Minister suggested that there had been some progress towards negotiating the release of hostages. How confident should we be that there may be a ceasefire deal or the further release of hostages by the end of this year?
I think a measure of confidence is warranted. Yet again, Netanyahu's rhetoric, his phrasing here suggested a measure was all that should be allowed at this point in time. We're days away from the new year, and we saw in the last 2 weeks a surge of speculation, a surge of upbeat statements, mainly from Israeli officials, about the prospects of a deal coming through. This was not matched by Hamas, the party holding those hostages. There was some indication from the outgoing U.S. administration of Joe Biden that there was optimism in Washington as well. That has yet to come to pass. So I think what the Prime Minister was doing is trying to manage expectation, trying to set things straight. He did not get into specifics, but some of his aides have said that apparently the Hamas has now relented on its demand for an a priori undertaking by Israel to end the war and withdraw all forces from Gaza, at least for the first stage of a proposed hostage release, meaning not all of the hostages, but the more vulnerable hostages, the women among them, the infirm, and the elderly. So there's a chance this might happen before year's end, but nothing is certain.
Dan, let me ask you an outlook question for 2025, given it's my last show of the year for 2024. And I'm just curious to see what you think the Israeli government's priorities are going to be going into next year. Obviously, there is a ceasefire that's still standing with Lebanon's Hezbollah right now. We have a new U.S. administration coming into office beginning of January. You have all of the changes in Syria. You have ongoing strikes from the Houthis, and they now just claimed responsibility for the killing of Ismail Haniyeh that took place in Tehran many, many months ago. There's still a lot of things going on. And then we were just speaking about the potential for a ceasefire in Gaza. What do you think out of all of those things that I just listed is going to be the priority for the Israeli government?
Well, I think while Israel can rightly claim to have smashed the Iranian axis mostly over the last year, that array of proxies of Tehran, everywhere from Hamas in Gaza to Hezbollah in Lebanon to groups in Syria, perhaps as far away as Iraq, as you noted, the Houthis in Yemen are still fighting and very actively. In fact, just last night, overnight, about 2 o'clock this morning, it appears the Yemenis fired another ballistic missile at Tel Aviv. It was intercepted. But they've been managing this on a pace of about once every 2-3 days, which is impressive given the distance and given the economic standing of that country and that group. So Israel will be focusing, it's already said this, on preventing the Houthis from further attacks, perhaps even trying to put them in a corner. And I think it will also be focusing its efforts on coordinating with a very friendly incoming Trump administration in the United States, friendly to judge by the open statements made by the president-elect and his senior aides on wrapping up that war, tackling Iran's nuclear program, and perhaps as a result of that, finally sealing a normalization deal between Israel and Saudi Arabia, the Saudi Sunni powerhouse in the region. That would really be a crowning point for Netanyahu's career, a career that's taken quite a battering over the last 2-3 years.
Yeah, a very interesting one, that one, and certainly might be a focus for the incoming Trump administration as well. Bloomberg's Dan Williams in Jerusalem, always great to chat to you. Thank you. Now, still ahead, we speak to Change Global Managing Director Thea Jamison about their outlook on foreign direct investment trends for 2025. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. One of Southeast Asia's biggest fund managers has said that Thailand and Vietnam will be amongst the top beneficiaries of Donald Trump's return to the White House, highlighting the shift in sentiment from North Asia to other Asian nations. Let's get the view of our guest, Thea Jamison, Managing Director at Change Global. Good to see you. Thanks for logging on from San Francisco today. You obviously were in our office in Dubai about a month ago and then continued on to Asia for this tour around the region. What were some of your main takeaways from just being on the ground there?
Great to see you, Jumana. We traveled through Taiwan last week, and there is no substitute for being on the ground and doing the due diligence. Taiwan, of course, is the epicenter of the high-tech supply chain and very, very important for the region. We came back with two important takeaways. One, innovation is well and thriving, and two, the FDI realignment is taking place and, if anything, accelerating. On the innovation front, we met with Foxconn, one of the leaders in the space, which very, very interesting, shared their transition from an iPhone maker to an electric vehicle innovator. They quoted their early implementation of artificial intelligence and how that has changed, improved productivity by roughly 80% increase in revenue per employee.
Yeah, that's really interesting. And actually, in the context of the news of the day, Nissan, Honda, Foxconn was actually one of the names rolling around before Honda came in as a potential acquirer of Nissan. So no surprise there that they've talked to you about their own EV ambitions and evolution. Just to bring it back to sort of what is priced in, this morning, TSMC stock has hit a record high. And I just wonder whether most of the positive outlook and these productivity gains that you just talked about now have been fully priced in to where many of these assets are trading.
So what we heard repeatedly in speaking with the supply chain in Taiwan is that the movement into Southeast Asia is well underway. And if you look at the numbers, they're supportive of that evidence. So this is movement of FDI from China as well as Taiwan into countries such as Vietnam, Malaysia, Indonesia. In our research, we believe that Vietnam would be a big beneficiary. And Foxconn recently announced close to $1 billion investment in manufacturing smart devices. When we do the numbers, we see that Vietnam's share of Asian FDI has grown from roughly 4% before the pandemic to 6% during the pandemic, and first half of this year to well over 15%. So we're seeing more investment in manufacturing, but we're also seeing investment in research and development by the likes of NVIDIA, which only last month announced a new innovation center.
Thea, what is the rationale for the FDI going into these other countries? Is it a cost-driven decision and the fact that costs in China have risen over the last decade, or is it a geopolitical decision and that many of these companies just don't want to get caught in the crosshairs of what's happening between the U.S. and China?
I think it's both, and this diversification has been underway for several years. In the case of Vietnam, for anyone who has traveled to Vietnam, knows that the work ethic is unparalleled. There's an incredible sense of high energy and dedication. But if you look at the cost side, it's very, very economical. Land prices, for example, are half what they are in the surrounding Southeast Asia and less than half what they are in North Asia. And certainly the cost of labor is also a very strong advantage.
Yeah, fascinating. Well, when you were on our show back in Dubai, we also talked about some of the emerging opportunities that you're seeing in Africa. You spoke about the Johannesburg Stock Exchange. Let me just ask you, as we head into 2025, whether you see continued momentum in some of the trades that you spoke about a month ago.
Absolutely. We're so excited about sub-Saharan Africa in particular. If you look at the big three markets, and these are South Africa, Kenya, and Nigeria, they're all re-rating They're up 30% each in Kenya and Nigeria. South Africa is up over 10%. They're still very inexpensive. Valuations are in the 5 to 6 times price to earning range, which is about a 50% discount to historical averages. And lastly, they're being propelled by domestic investment, which is very encouraging. These markets do not need foreign flows to re-rate.
Interesting you say that. And just to end on that point, because of what you were saying about FDI in the Southeast Asian part of the world, why do you not think those particular markets and jurisdictions don't need the help of foreign flows to come in?
So what we have seen is a dramatic rise of the domestic investor. Just several years ago, the participation of local investors as part of daily flows was under 50%. Those markets were very dependent on foreign investors like ourselves. Today, local investors are well over 70% and more in some markets. That makes them less dependent on foreign portfolio flows and much more reliant on the rise of domestic assets.
Very clear. Thea Jamison, always a pleasure to chat to you. Thank you for taking the time to speak with us. Managing Director at Change Global. That was Thea Jamison. Now, coming up, a national security panel has deadlocked on the sale of U.S. Steel, leaving President Biden with a decision. We'll get the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Shimona Versace in Dubai. President Biden is set to make the final decision on the sale of U.S. Steel to Nippon Steel. That's after a national security panel deadlocked on its review of the sale. The president has long indicated his opposition to the transaction. So for more on this, Bloomberg's Stephen Soshinsky joins us now. Stephen, interesting that this committee couldn't come to an agreement on whether they think the acquisition would pose a national security threat. Why will President Biden have a clearer view of what should be done here?
You know, he's for the last few months indicated that he doesn't support the deal. He hasn't outright said, like President like Trump, for example, that he would kill it, but he's indicated that he doesn't support it. He thinks that U.S. Steel should be American-owned. Now, there's a long storied history to U.S. Steel. It played a big part in the U.S. economy for decades after World War II. As well, Biden is from Pennsylvania, home to U.S. Steel and the steel industry in general. There's this fear in not only in the White House, but also in the CFIUS review that potentially the takeover of Nippon Steel, of U.S. Steel, could be it could reduce production in the U.S. It could lead to Nippon Steel picking other areas for investment, reducing the influence the U.S. has in the industry. Now, Nippon Steel has countered by saying that won't be the case. They plan to invest more in the sector in the United States, as well as appointing officials in the U.S., Americans, who would help lead the company. So that's essentially where Biden stands. It seems more as well to do with politics because it was a tough election year, and the unions were strongly and still are strongly opposed to the takeover.
Yeah. Stephen, is there anything that Nippon Steel could offer in the way of sweeteners to help get this deal across the line by saying they put, say, U.S. citizens in management positions or something of the like?
Yeah, I mean, you know, that's an interesting thing because they've actually done that. They've sweetened the deal multiple times. The $14 billion takeover includes a promise that they will not have any layoffs for a number of years, at least for a number of years, to the union, to try to make the union happy. They promised additional investment. They promised to divest from other U.S. facilities to make sure that there isn't some sort of different issues with other regulations. They've really gone out of their way to say that they're out to provide the best possible deal. I don't think there's much more Nippon Steel can do at this stage to offer. It's really up to Biden in the next 15 days whether or not to approve it. U.S. Steel, the president of U.S. Steel, did come out with an appeal in the New York Times over the weekend saying, hey, listen, this tie-up between U.S. Steel and Nippon Steel, this will make the company stronger, and this will put them on a better footing to compete against China, the world's biggest producer of steel.
Very fair. Stephen Tuchinski in Singapore for us. Thanks very much. Quick look at equity futures before we head to the break. Things are leaning towards the reds, but coming up, we're going to be talking about West African juntas dismissing a proposal to delay their exit from a regional bloc. We speak to Mucahid Durmaz, Senior Risk Analyst from Verisk Maplecroft. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Honda surges after announcing a $7 billion buyback following a tentative deal to take over its weaker rival, Nissan. President Emmanuel Macron names Eric Lombard as the new French finance minister. Prime Minister François Bayrou says he wants a budget deal by mid-February to cut the deficit to close to 5%. Plus, Syria's new de facto leader, Ahmed al-Sharaa, holds talks with senior diplomats from Jordan and Qatar. It's just gone 9:30 a.m. across the Emirates. I'm Jemana Bersechi in Dubai. Welcome to Horizons Middle East and Africa, our second half of the second hour, and my last show of the year. Let's take a look at how these markets are faring. S&P futures not doing a whole lot. Yesterday on the data front, we did get a bit of a decline, a surprisingly low investor consumer confidence print. So again, that is an interesting sign heading into 2025, given how much exuberance we're seeing in stock markets and how much noise there is about U.S. exceptionalism. So keep an eye on the data that comes through in the next couple of weeks. That's all I would say. But S&P as a whole on track for gains of more than 25% year to date. Half of that led by the Magnificent Seven stocks. So it's still quite concentrated. The handover from Asia Pacific, mostly positive. But you can see up 0.4%, Hang Seng leading the charge overnight. And then Brent sitting shy of $73, up 0.4%. We've been trading in a very tight range over the course of the last few months, despite the geopolitical noise and some of the announcements coming through from OPEC+. And then dollar yen also in focus today. We are slightly stronger versus the USD. So the yen is about 15 basis points firmer versus the greenback. But we did get some interesting comments from the finance minister overnight saying that they will not tolerate excessive moves. So a bit of jawboning going on there. The other chart that I want to draw your attention to is we were talking about the rise in U.S. yields since that hawkish Fed meeting last week, with U.S. yields, just a 10-year yield, sitting shy of 3.6%. But take a look at this. Typically, what you would see is for interest rates to rally, for yields to go down after the first cut in the easing cycle, all the way back to the 80s. That typically is what would happen. 2024 has been different because 10-year yields have moved up 81 basis points since that first Fed cut. So something to think about there. And again, as we sit on levels that are pretty high in yield terms as we get into 2025 versus where we were a couple of months ago. Now, military leaders from the West African Junta-led nations of Mali, Niger and Burkina Faso have dismissed a proposal from regional trade bloc ECOWAS to postpone their exit by 6 months. Mali's military leaders said the move is another destabilization attempt, targeting the Sahel states in a last-ditch effort to avoid its fracture. For more, let's bring in Bloomberg's Andiro Aganga. Andiro, walk us through what is going on here and why these Sahel countries were so keen to leave ECOWAS.
Jumana, there are a couple of headlines here. You have this Sahel state saying that ECOWAS is under French influence, and that's why there's that spirited opposition against them. And they're also saying that ECOWAS has sort of deserted them. They've not supported them security-wise in their fight against Islamist insurgency. On the other hand, ECOWAS has a zero-tolerance policy towards military coups. But in the last 5 years, we've seen 7 coups, with the latest one being in Niger. And on top of financial and economic sanctions, ECOWAS threatened military intervention in Niger if President Mohamed Bazoum was not reinstated back into power. And this is where we've been seeing that push and pull come from. ECOWAS says they would like to see a resumption of civilian government, but no election dates have been set in these three countries. And this exit will have quite a lasting impact on the region, because if they choose to leave, then imports and exports are going to be affected, because these three countries are landlocked.
Excellent reporting, Bloomberg's Nziro Ganga. Let's get more analysis now with Mucahid Durmaz, the Senior Risk Analyst at West Africa at Verisk Maplecroft. Let me just ask you, Mucahid, how significant do you think it is that these Sahel countries have decided to leave ECOWAS? It's not a surprise. They've obviously been warning that they're going to be doing it for a while now.
I think it's significant, but considering their political steps over the years, their latest decision to reject the ECOWAS proposal is not indeed surprising. It's once again clearly demonstrate that there's a little chance that these Sahel countries will remain the members of the bloc. Ever since these militaries came to power in Mali in 2020, Burkina Faso in 2022, and Niger, they made it crystal clear that they want to leave the bloc. And I think at the heart of the issue is that these military governments' lack of commitment to lead a transition to democratic governance. By cancelling the transitional elections that the transition in these countries were supposed to have, Sahel military governments illustrated their intention that they are there to stay in power. On the other hand, military coups is a red line for the region bloc, ECOWAS, and the bloc believes that recognizing these military governments as a legitimate bloc members would clash with its principles and further diminish its already low credibility in the eyes of West Africans. What we have right now is that the Sahel countries' departure from ECOWAS is inevitable. We will likely see a divided West Africa along the ideological lines. So one side, we have a landlocked Sahel countries that are allied with Russia, and on the other hand, we have a more market-friendly coastal economies that have more warm ties with Western countries.
Yeah, so this was going to be my next point, the broader geostrategic implications and the fact that these Sahel nations are going to be closely aligned to Russia and Russia-backed military groups. What does that do for the broader geopolitical context of the war that is going on between Russia and Ukraine, U.S.'s position vis-a-vis Russia? I mean, does this tie into a bigger picture politically, or is it still going to be specific to the African continent?
Yeah, I mean, firstly, there's still a unclarity as to how this breakdown will happen. But given the statements and the steps by the both sides, it appears as though the Sahel countries' exit will likely take a form of political departure rather than a complete breakdown of the relations. Sahel countries and ECOWAS, they try to preserve their economic and military ties in order to minimize the potential disruptions to their economies, because they both sides rely heavily on each other in terms of infrastructure, agricultural products, and energy. And I think that's important. Given in terms of implications, implications are huge. Firstly, security, strained ties with next-door military governments carry significant ramifications for these coastal countries because weak regional military corporations risk enabling an expansion of the military militant groups in the countries like Ghana, Nigeria, Benin, Togo. That's very much a big concern. In the long run, this split will definitely impact the regional trade, but there's also geopolitical fragmentation, as you mentioned. These fragmentation will deepen the disunity between these countries because Sahel countries reliant on Russian military support, but it's also the Western Bloc in recent years increasingly focused on the security situation and coastal economies. We will see that the regional diplomacy and trade will likely remain under pressure from the political pressing political issues in these countries.
Mucahid, I thought it was interesting that the three countries put out a statement where they specifically talked about and this is a quote, the French junta and its lackeys. What does this tell us, that statement in itself and the representation of how they see France signify vis-a-vis the West's place in Africa and the void that has been created for the likes of Russia, Russian-backed militaries, and even China to come in?
Yeah, I mean, that statement reflects once again how the military governments see the relations in the region, but it's also with the rest of the world. From the beginning, when ECOWAS imposed sanctions on these military governments in Mali, Niger, and Burkina Faso, the military leaders in these countries pretty much were under impression that the ECOWAS leadership was led by France, and these orders of sanctions were actually coming from Paris rather than Nigeria, Ghana, Senegal, and other West African countries. So that statement certainly reflects that, and I think moving forward, as I mentioned, this geopolitical fragmentation will definitely create a disunity among the Sahel countries. Moving forward, I think what ECOWAS could do is to maintain this economic and military ties and also ensure that there's a smooth transition for both countries moving forward, because big regions, economic heavyweights like Cote d'Ivoire, Nigeria, and Ghana is pretty much under the risk of expansion of the militant groups coming from Burkina Faso, Mali, and Niger.
Mucahid, you wrote a report recently saying that Africa's conflict corridor now spans 4,000 miles from Mali in the west to Somalia in the east, and it's doubled in size since 2021. On this show, we spent a lot of time talking about the economic opportunities in the African continent. Given the expanding conflict corridor, how much of a risk does that pose to the continent?
I think there are multiple risks that it poses. Certainly, the conflict itself make it very hard for investments and investment opportunities, specifically for extraction center. But it's also the fallout impacts of this conflict that is also important, because it facilitates and triggers political instability, and that political instability takes the form of increased resource nationalism in the region as well. That's what we've seen. Speaking of Sahel countries, we've seen an increase in resource nationalism in Mali and Niger and Burkina Faso. We see that companies' operations were shut down. There's so many issues with licensing and local content laws, but it's also more and more governments, Mali, Burkina Faso, Niger, Chad, they either try to increase their stakes in the energy projects, also sort of scrutinize the investors, mainly foreign mining firms, sort of with the strict tax assessments as well. So there is an obvious threat of conflict on the ground, but it's also the fallout impacts of this conflict when it comes to business landscape in the region. So we anticipate that the conflict will certainly become a major issue when it comes to investment and business moving forward years ahead.
Yeah. Thank you very much, Mucahid Durmaz, Senior Risk Analyst in West Africa at Verisk Maplecroft. Now, Nigeria's president has defended his sweeping economic reforms, which triggered soaring inflation, led to a cost of living crisis, and sparked deadly protests. Bola Tinubu told a rare media briefing in Lagos yesterday that the measures, including devaluing the naira, abolishing a complex exchange rate system, and scrapping costly gasoline subsidies, were necessary to prevent a national crisis. Fresh protests have erupted in Mozambique after the country's top electoral court declared Daniel Chapo as president-elect. The court ruled Chapo won with 65% of the vote, less than the 71% the Electoral Commission had said he received. Second-placed opposition candidate Venancio Mondlane received 24% of the vote. And the announcement follows weeks of deadly unrest, which saw at least 130 people killed and disrupted operations at the nation's biggest port. Chapo is due to be inaugurated on January 15. Coming up, Eric Lombard, an experienced finance professional and former CEO, has been appointed as France's finance minister. We're live in Paris to discuss what's next in the country's quest for political stability. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Versace in Dubai. French President Emmanuel Macron has appointed Eric Lombard as the country's finance minister. Lombard, an experienced finance professional, will be tasked with passing a 2025 budget and lowering the deficit. For more, let's bring in Bloomberg's Claudia Cohen in Paris. Claudia, I've been saying Eric Lombard because it sounds French, but it could just be Eric Lombard. What do we know about this new finance minister?
Well, so this new finance minister is one of the most interesting profile. So he used to be a former banker, and he used to be a top executive in the insurance sector at BNP Paribas, but also generally in France. So he knows extremely well the financial sector. And earlier in his career, he did have a previous experience in cabinet. He used to work when he was younger for the ex-socialist economic minister, Michel Sapin. And now he was, until now, actually leading La Caisse des Dépôts, which is basically kind of the financing arm of the state, which invests in long-term investment like infrastructure, public housing. So it's a really, really interesting profile. And I would say that it's the less boring one because this new cabinet really, looks a bit boring. There is no surprise, really.
Okay, well, I don't know whether that's going to be a good thing for investors, but certainly good for us in the news to get a not boring cabinet. Let me ask you a question, though, about the work that is cut out for him, because it's all about the deficit in France. They're on track for a 6.1% deficit for this year. There's been talk of them wanting to reduce the size of the deficit to 5%. But of course, Claudia, if they come out with plans that are too aggressive or they try to trim the deficit too quickly, then Marine Le Pen is going to have issues with that. So talk us through the main challenges of the government.
Exactly. So the opposition have been, they shown little intention to make some compromise. So you talk about far-right Marine Le Pen, but let's talk about also the socialists. So this guy, Eric Lombard, but also François Bayrou, obviously the Prime Minister, they will need to find, let's say, the right equilibrium between how much of public spending do you cut and how much tax increase are you putting more on companies but also on household. So I would say on the far-right party, the most feared one are the tax increase on household. And from a socialist point of view, obviously, the left wing, they want more tax on corporates. So it will be difficult for Eric Lombard to find the right equilibrium. And yesterday, actually, so like after the new cabinet was appointed, François Bayrou, the Prime Minister, he was on French TV, and we could say that he had kind of a pro-business stance, saying that companies shouldn't have to carry all the burden of the debt. So my guess is that we could expect a less aggressive tax increase plan on companies than the one that the previous Prime Minister, Michel Barnier, was expected to do.
Yeah. Is there a sense that this is maybe a bit of a last chance saloon for French President Macron? There's been multiple attempts at forming government. The Barnier government didn't last very long at all. If this government doesn't work out, then could the walls be closing in on Macron?
Well, I guess you're totally right, because like this new government, so a lot of Michel Barnier ministers were reappointed actually, and a lot of Emmanuel Macron support are also in the government. Like all those ministers are seeing a kind of really experienced politician. So this is kind of the last chance, because if they can't make it, who can make it in the end, And if the left wing and the far right are not willing to compromise with this new government, knowing that obviously the fiscal situation of France is really bad, we don't think that there will be any other issue, But in a way, let me say that when you talk of the record with some companies, they tell you that maybe it's not for the worse. I feel that French people, but also companies, groups, but also the small companies, for them it's really difficult. They're just expecting the road to be smooth, They don't want any new tax. They just want clarity. Until the next presidential election in 2025. So we'll see. And just to recall, this new cabinet, so François Bayrou, the new prime minister, could face a no-confidence vote as early as mid-January. So the new cabinet will have its first meeting on January 3rd, and then François Bayrou will give a kind of his plan during a speech in front of the National Assembly on the 16th of January. And just after that, a few hours after that, there could be a no-confidence vote. So the question is now how long the government will last, and let's hope that it will for French finance.
Very clear, and especially the mapping out of the timeline the next couple of weeks. Bloomberg's Claudia Cohen in Paris. Thank you very much. Well, coming up, China is planning to make stimulating demand and consumption a top priority in 2025. More on what this means for luxury brands next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Dutch chipmaker ASML is known for making machines which create the building blocks of the AI revolution. But it's gone for different blocks to celebrate its 40th anniversary. The company's employees have been able to buy Lego replicas of ASML's most prized product, the TwinScan EXE 5000. The Lego models were being sold for $216 on ASML's employee store. Meanwhile, a full-sized machine costs around $380 million and weighs as much as two Airbus A320. So if you're watching this show, not only are we giving you key economic insight, but we're giving you Christmas plans, Christmas ideas as well. So there's one from ASML. All right, key Chinese economic meetings this month have revealed that officials are planning to drive up demand and consumption, their top priority in 2025. That will be welcome news for luxury brands who've seen sales slide as shoppers tighten their belts.
This 5-story Louis Vuitton flagship store in Beijing was supposed to open its doors to shoppers in early 2024. LVMH CEO Bernard Arnault told Bloomberg he was optimistic about the group's growth in its largest market.
I am always optimistic, and the people have often concerns which are not materialized.
But now, sources say the store may not open until as late as next year. The slow progress is symbolic of the challenges European luxury brands face in China. LVMH shares have plummeted since the start of 2024, revealing the scale of the slump in demand from Chinese consumers. Another luxury group, Kering, warned that its annual profit will fall to the lowest level since 2016 due to weak Chinese demand for designer bags and clothes. Prestigious watch brands like Richemont, the group behind Vacheron Constantin and IWC, and Swatch Group, owner of Omega, are also affected. Swatch shares tumbled this year after sales in China, which account for about a third of its revenue, fell sharply.
Many watch manufacturers are really dependent on China, generating 40–50% of their sales.
This pullback in lavish spending is hitting some of the world's richest. LVMH CEO Bernard Arnault's fortune tumbled from the top spot in the Bloomberg Billionaires Index. Founder of Kering, François Pinault, fell out of the global 100 richest. Shoppers in the world's second largest economy are shying away from excess buying as Beijing grapples with low domestic consumption and a shaky property market. President Xi Jinping's government has rolled out a series of stimulus measures to boost sentiment. Bloomberg Intelligence says China's luxury goods